Hello Fiona, how are you?
Yes, I'm fine, thank you. How are you?
Yes, I'm good. How was your weekend? Good?
Yeah, I did quite a few questions over the weekend and yeah, my
Yeah.
brain's all fuzzy now.
Yeah. I sent you the answers for those questions.
Yes, I saw those, yes, and
Yeah.
yeah, that is a bit of a concern that you can kind of go off on the wrong tangent a bit with some of these
Exactly, yeah,
questions.
that's right. Yeah, because I think the second one you handled it very well, the IFRS 5, but the
Yeah,
other two they have a little bit of technical areas. So particularly go to
yes,
IS 440 investment property. Always there is some kind of a question on that one. Try to look at
yeah,
IS 40 and also look at the IS 19 because they are the key important ones.
yeah, and also the financial instruments.
Financial instruments, exactly. Yeah, that's right. Yeah, that was the
Yeah,
other one.
maybe.
Yes, yes.
Yeah, maybe we could we have a refresher on financial
Sure, sure,
instruments?
sure. We will
Yeah,
do that one. Yeah, maybe tomorrow we will try to work on the financial instruments. Yeah, definitely.
yeah, okay, yeah. And I the other question, I haven't quite finished it, but I did
Okay.
do the bubble question yesterday.
Okay.
But I did run out of time because I needed to cook dinner for the children. So
Okay.
I've got
Okay.
a
Right. No
bit more to
problem.
finish.
Yeah. Just take it. I
Yeah,
want to. I was
yeah,
in fact just before you came. I was looking at this CP question again. It's a. It's
yeah,
a. It's a huge question. Uh,
yeah,
Probably I think the examiner does not want us to get the full marks there. Uh, it's a huge one. Every area you have to go through. So I thought anyway, lucky that we came across this question. So you remember we started on that question last time.
yes,
Send me an answer for this question. So remember revenue, there was
yeah,
no problem. Your revenue figure was all right. Have you got the question with you, answer with you?
yes, I have. Yeah,
Yeah.
yeah,
The
I've got that.
group revenue, you didn't have a problem. That was all right. But cost of sales, we had to do a little adjustment
Yes,
for
yeah,
that excess depreciation on the value uplift, because what we saw was they, in a rush, they went by the net values, but then later on, I think they had to do something, and then they found the fair value of the net asset finalized at 154. So there was a adjustment. The value what they had was, I think, 144, if I remember right. Yeah, let's see what they had on the disposal. Dispose 20%, 40% holding. Yeah. What they said was there was 100 and how much was the disposal? CP acquired 80% due to reporting. Yeah, they took the finalized at 54 million, the net assets. What was identified. Note number 3.
yes, yeah,
Right? The fair value of the net assets identified was 54 million. But then what we did was we worked backwards, I think. Net assets at disposal was finalized, acquired 80%, fair value of calculated due to a tight reporting. Fair value had not been finalized by the finance. Goodwill was calculated using the carrying value. Yeah. So the goodwill was calculated with the carrying value of the asset. So the carrying value of the asset was the fair line had not been, goodwill was calculated using the, so what we did was we knew the goodwill, we managed to carry, I think we managed to work out the carrying value of assets, if I remember right. Let's see what we did there. Yeah. But we know what the fair value of the consideration received for 80% was 60 million. For the consideration of 60 million cash, the non-controlling interest was 12 million, and we worked backwards the goodwill what we have got there. Goodwill was 28 million. So from there
yeah,
we worked backwards to find out the carrying value of net assets was 44 million.
yeah, and that was a balancing
Yeah,
figure.
working backwards. But then later on, they found it to be 54 million. So because of that, what we had to do was we had to increase the value of the carrying value by 10 million. The moment you increase it by 10 million, what happens is your goodwill comes down from 28 to 18.
Yes.
So that happened there. Then there was another thing, little thing, what happened? I also did this question. Yeah, depreciation on the fair value uplift. So there was a fair value uplift of 10 million, right?
Yeah.
The fair value uplift was 10 million. The 10 million, it was on 2000 public company. The purchase consideration was 30th of June. It was acquired. Now what is our date? Yeah, 2016, it is P&L. So 10 million, we need to depreciate it over a period of 5 years because that was the depreciation, the thing that what they said, the only accounting for the in relation to, yeah, say was fair value of which remain in useful life of 5 years. So that 10 million excess value came due to the plant, which has a life period of 5 years. So every year, 2 million additional depreciation need to be provided in the P&L.
Yeah.
So because of that, our cost of sales figure, which you worked it out at 304 plus 57 plus 72, I increased it by another 2 million. And that's how we got our final cost of sales figure. Ultimately, it was going to be 435.
Yes.
You had 433. I increased it by 2 million for that excess depreciation on the excess revaluation. Revenue is 615. So we came to a gross profit of 180.7.
Yes.
Now we come to a big one where this is where we stopped last time, the investment income. Investment income, the parent company had 42. Guinea was our 9 months company. Guinea had how much investment income? Guinea had 19. Of that, we took only 12 over 9, 9 over 12. So that is how you got 14.25, right?
Yes.
So investment income was 42 plus 14.25 plus 5. That was your investment income. But we have few adjustments to do. So you have taken that figure 42 plus 14.25 plus 5. But remember, look at what they say. Now this is what I want you to catch up. Look at note number 2. If I was in this exam, I would have underlined that one. In the 4th line, note number 2, CP accounts for investments in subsidiaries at cost and has included a gain in investment income of 14 million within its financial statements to reflect the disposal. So what they have done is the 14 million which they thought is a gain on disposal, they have credited it to the investment income.
Okay.
But we know in consolidation, it is no longer an investment income when you dispose a subsidiary because they disposed from their 60, they came down to 40. So it became associate company. When they dispose a subsidiary, that if there is a profit, that profit must be taken straight to the P&L, not to the investment income. Not to the investment income. So that 14 million, which is reflected in the parent's company investment income of 42 million, we have to remove.
Yeah.
That's the number 1. We must remove that one. We have to really work out the real profit or loss, and that should be taken as a credit to the P&L. that should be taken to the credit of the P&L. If it's a profit, it must be taken to the credit of the P&L. If it's a loss, we must take it to the credit. They must debit it to the P&L. So at this point, before I go further, I want to work out whether in disposal, whether we had a profit or not. You remember there was a little bit of a problem here. The remaining 40% had a fair value. The CP accounts for investment and has included the gain in investment of 14 million with it. So we have to see whether in fact we had a gain or a loss. So I just want to do a quick calculation to see whether we had a gain or a loss. Even though you can look at, I want you to look at the wording. For investments that a cost has included in gain in investment within which to reflect the disposal. To reflect the disposal. They don't say how they arrived at the 14 million, or they don't say even it is the profit. But what they say is they have credited 14 million to the investment income, so I removed it.
Yeah.
Now I want to go back and see what is my total figure. What is my, on the disposal, how much did I get? That's what I want to look at. Right? So to get that one, I need to go a little bit. You see, net assets on the disposal date. When was the disposal happened? This disposal happened on equity on 31st March 2016. Right? 2016. So it did not happen. I think, did you work out on the disposal profit or loss in your workings? Don't think, no?
No, I don't think I did. I think I needed help with that section.
Yeah, because I think what you did was you just took the 14 and just left it there. But we know that 14 is wrong to keep it there. So I removed the 14. But now I'm going to work with you the disposal. So if you remember in consolidation in the disposal, what we have to look at is the consideration we have received for the sale plus whatever the leftover, the fair value, right? Whatever the leftover, the fair value, we have to consider those two plus the NCI what we are removing on the day of the disposal. Against that one, we must compare the net assets on the day of disposal. So I just want you to take a little note on that one. Whenever we want to consider the profit or loss on disposal, what we take, consideration received in this case for the 20%, how much? 44 million. Right? Then the next one is the remaining 40%, what is the fair value? The remaining 40% on the day of disposal is 62 million. So 44 plus 62. That is my first two items. 44 is the consideration that I got. The fair value of what I have is 62. I need to work out the other one. What I need to work out is the NCI, which I'm going to dispose on the day of the disposal. So that figure must be added up. I will add up that in a moment. That must be compared with the net assets what you are disposing plus the goodwill.
Okay.
On the day of the disposal. So that is what we should be looking at. So I want to look at that figure now with you straight away. So 44 plus 62, all right. Now I want to go into the non-controlling interest disposal. On the day of the disposal, what is the non-controlling interest? We know non-controlling interest on the day of acquisition, when they took that remaining 40% had this thing, all that they say had included net assets had CP on Genie, non-controlling interest on the day of the acquisition was 50 million.
Yeah.
But that's on the day of the acquisition. Since then, the company has made a profit. So what is the profit they have made? When they acquired, it was 114 million. Correct? The net
Yeah.
assets on the day of the acquisition, 114 million. But now they have found the net assets to be how much? On the day of the disposal, when was the disposal took place? 31st March 2016. So we want to find out on the day of the disposal, what was their net assets. So do they give any figure for us on that one? Included gain and investment of 14 million to reflect the 118 million. On 1st July, the net assets on 1st July is 180. That also we know. So we want to calculate the net assets not on 1st July, we want to calculate it on 31st March 2016. Right? We want to calculate it on 31st March 2016. So how can I get that figure now? Look at the total comprehensive income of this company called Genie.
Yeah, so that's the opening balance, 118.
18 is the beginning balance. 18 is at the beginning of 1st July 2015. But we are 30th of June 2016.
Yeah.
Right? So 9 months into the year, we sold this. 9 months into the year, we sold it. Right? So what we have to calculate is what is the entire profit that Genie made this whole year. Look at the total comprehensive income that Genie made for the whole year, and then we can take up to 31st March the 9-month figure. So what is the profit that Genie made? What's the profit that Genie made in this full year? This is for the year ended 30th of June 2016. Genie made a profit of total comprehensive income to income. What she has made is how much?
48.
How much? Genie?
Total comprehensive income's 48.
48. How did you get that 48?
It's just at the bottom.
Mm-hmm. Yeah, good. Profit for the year. Total comprehensive income is 48. Of that, 9 over 12 is what they have made during the first 9 months. So at the beginning our net assets are 118. With the 9 over 12 profit, our net assets on the day of the sale, we can work it out. How much is that?
36 million.
36 million. 36 million. So 118 will go up by 36. It will be 154 million net assets on the day of the disposal. When this company was taken over, what was the net assets at that time? 114.
Yeah.
Right? 114. When Genie was acquired, it was 114. 44 million disposed. No. Where was Genie? Where did I get that 100 and net assets had a fair value on 1st July 104, 13. Yeah. CP acquired Genie. At that time, the net assets were 114. So from the date of acquisition to the date of sale, the net assets have gone up from 114 to 154.
Yeah.
So 40 million, they have made a profit during this post-acquisition period.
Yeah.
Right? 40 million is the post-acquisition profit, and of that, 40% at that time the NCI was 40%. So 40% of 40 million is the NCI share that they will get.
16.
16. So your total NCI value what you are disposing is 66. Right? At the beginning, at the time of acquisition 50. Now we have made a post-acquisition profits. The NCI shares, because NCI share at that time was 40%. After that, no more NCI. After that, we become a non-controlling person. So up to that point, non-controlling interest people should get the total amount is 66. So this is what we are our consideration plus the NCI figure is 44 plus 62 plus 66, it is 172. Now what we have to see is, for this amount, how much did we dispose? We disposed the 154 net assets, correct?
Yes.
We disposed 154 net assets, and what else did we dispose? What else did we dispose?
Sorry, can you repeat that?
Yeah, sorry. We disposed the total net assets of 154.
Yes.
We disposed the total net assets of 154. I'm asking, what else did we dispose for this 172 consideration plus NCI? We disposed something else. What was that?
Goodwill.
Goodwill. How much was the goodwill? How much was the goodwill? I think you worked out the goodwill.
18.
Hmm?
It came down to 18.
That was on the other one, no?
Hang on. That was on Boo, yes, sorry.
Yeah, the Genie, how much
Genie,
was it? Yeah.
I did work out the disposal. Hang on.
I think you worked out the goodwill. I saw something.
Oh yeah, I did do the disposal as well. I didn't think I had. The goodwill was 26.
Goodwill was 26. You're right. Yeah, goodwill was 26. Right. So you disposed a goodwill of 26. So total what you disposed was the net assets of 154 plus a goodwill of 26.
Yeah.
So 180 you disposed, and finally how much did you get? 172. Correct?
Yes.
So there is a loss. It's not a 14 million profit. There is a loss of 8 million, which should come in the P&L at the bottom part. I mean, not in the OCI. It's a realized disposal. It must come in the bottom part as other expenses or whatever it may be. The goodwill, the disposal loss is a 8 million loss. It's a 8 million loss. That should have been shown. So you can see that it's not. So that's the answer. So 14 million we have to remove from the investment income, and we have to bring a loss of 8 million through this all the calculations what we have done. I just want why it's not part of the question, but I want you to know how they arrived at the 14 million. Wrongly they have arrived at 14 million. How did they arrive at? They sold it for 44 million, right? The 44 million is what they sold it, the money what they got. What they did was, you remember the consideration they paid was 90 million at the beginning. So in a typical normal accounting work, 90 million for 60%. Now what they did was they calculated for 20%. That's a normal way we calculate the profit or loss on a disposal of a investment. 60% is worth 90 million.
Yeah.
90 million. And they will calculate, okay, how much is the 20%. So 20% is worth exactly 1/3, 30. They sold it for 44. That's how they arrived at 14 million. That's a normal way. If it was a normal investment, that's how you would have calculated the gain or loss. But when you dispose a subsidiary, you don't calculate like that. you look at the net assets on the day of this disposal, you look at the goodwill on the day of the disposal, and then you compare the consideration what you receive, consider the remaining balance, the fair value, plus the NCI value. So this is, I agree, lot of work to be done to arrive at these little figures. Correct?
Yeah. It's a lot of work for those marks as well.
Yeah. So I hope they will have a lot of marks on this one because there is a lot of work to be done. So one part of the investment income, now you will agree with me, it's 42 plus 14.25 plus 5, you remove the minus 5. But you will bring it at the bottom, a loss of 8 million, but you have just worked it out as the loss on the disposal of the subsidiary. So leave it for the moment. That's not the end. Some more things on the, I want you to look at the note number 5. During the explosion at a different office block caused substantial damage, and it was estimated that the fair value fell from 20 million to 14 million at 30th June. CP has estimated that cost of 3 million would be required to repair the block, but is unsure whether to carry out repairs or whether to sell the block for a reduced price. The property had been left in the financial statements at a value of 20 million. A provision of cost was charged to the expenses. Now, what is the adjustment you need on that one?
So there's an impairment of 6 million.
Impairment of 6 million. And what is this asset? This asset is an investment asset. Right? It's an investment asset. So therefore, that impairment also must be charged to the investment income.
Okay.
That should be charged to the investment income. So that was another one. What do you think about the 3 million? I saw something you had done on that 3 million. What you should be doing for the 3 million?
Well, I didn't think there was an obligation to carry out those repairs.
Yeah.
Because they're considering selling it as it is without any repairs being done.
Yeah, because there is no present obligation. So you can't, according to IS 37, you can't provide for future obligations, right? And therefore, the provision should be reversed.
Yeah.
The provision should be reversed. So that expenditure should be reversed back because it's not a real expenditure. You can't provide under IS 37 because there is no obligation at the moment to repair. So that should get reversed to the P&L. That I will come in a minute. So that's another adjustment what we have to do for the property income. But that's not all. There was another big one. I saw that one. What was that? It was on the investment property again. Right? CP holds properties for investment. This is a very, very nasty question, I'd say. But investment purpose at 1st July held a 10-floor office block at a fair value of 90 million with a remaining useful life of 50 years. First floor was occupied by CP staff and the second floor was left to Boo free of charge. The 8 other floors all led to unconnected third parties at normal commercial rate. So even though they have considered the entire 10-story building block as an investment property, we know we are occupying one and we are given it to our own subsidiary, Boo, another one free of charge. So
that's owner occupied, isn't it?
That's owner occupied. That should have been, if it is under balance sheet, it will be under property, plant and equipment. And when it comes for the investment income, we can only take 80% or take 8 out of 10 is the amount that what we are occupying. No, sorry, what we can consider as investment property. So therefore, on the property that on the part that what we are occupying, we have to charge depreciation. We have to charge depreciation. So what is the, what do they say? They say the first floors occupied, the other floors, it was estimated that the fair value of the block was 96 million at the closing. SIPI had a policy of restating land and buildings each reporting date. Only entry for the year ended in relation to this have been to correctly include the rental income and profit and loss. It can be assumed that each flow is equal value. Depreciation is charged to administrative cost. So at 1st July, it was 90 million. So on 1st July value, if we take 90 million, 20% of that is occupied by us.
Yep.
That is on the 18 million, right? And it has a life period of 15 years. So on that 18 million, we have to provide depreciation. 18 million divided by 15, we must provide depreciation.
Yeah.
So we have to have another setup there because we need to keep as depreciation 1.2 million, which should get into the depreciation because that is what we should be doing because it's not part of our thing. So what have they done? They have depreciation, they have charged it to administrative cost. Right? What would they have done? They would have charged the entire amount, the entire amount on the 90 million, the 6 million depreciation, they would have charged it to the PN. That is what they would have done.
Yeah.
Because depreciation is charged to administrative cost. So we have to make a little bit of a correction there. So first of all, let's calculate and see how much we should be charging as the depreciation. We must charge 1.2 million.
Yeah.
Right? 18. So they say, what do they say? Second floor left. SIPI has a policy of restating and only accounting entries have been to correctly include the rental income. So they have not charged the depreciation yet. Right? They have not charged the depreciation. So we know the correct depreciation to charge is only 1.2 million.
Yeah.
90 million, 20% is 18 million divided by 15. We will be charging 1.2 million depreciation. That will come to the P&L as a depreciation part of it. Now what we have to work out is on the investment part of it, whether because investment we don't treat it with depreciation, we treat it as a kind of a investment income because the moment we option IAS 40 to be applied, we had to calculate the investment in the associate company, how it should be. So 1.2 million, no question, we have to charge it to the depreciation. Right? So now what we have to look at is what they do with the revaluation. It was originally 90 million and now they have revalued it at 95 million. Right? 95 million. So when they revalue it at 95 million, what we see is it's our own property, plant and equipment. How much is our own property, plant and equipment? Only 20%. Right? Only 20%. So what is the original figure that we would have had? 18 million. At the beginning, the cost would have been 18 million and we would have charged 1.2 million depreciation. Now what is the written down value on the 30th of July 2016, 30th of June 2016? 16.8. Okay? Hello? Hello? Hello?
Hello. Oh, you're back again.
Something went wrong. Okay. I was talking about our property, plant and equipment component is only 20%. On that 20%, okay, on that 20%, 90 is the full value, 20% is 18 million. On that 80
Yeah.
million, we provided depreciation for the first year, 1.2, and now our 30th of June closing figure is 16.8. Agree?
Yeah. Yeah.
Now it is going to be revalued at 96 million. So 96 million when we revalue, 20% of 96 is 19.2.
No. Yeah.
19.2, correct? So that part of the revaluation from 16.8 to 19.2 should come to our revaluation reserves. So that will be under OCI. There will be a 2.4 which we have to classify as revaluation reserve.
Oh, it's not the figure that I had there.
Yeah, I know, because you did not provide depreciation on that one, no?
No.
Yeah. It's very difficult.
Okay.
It's not easy to think all these things. The only thing what I'm happy is when we do this kind of questions, you might have a chance. If you get this kind of a question, your mind will run into these things because we are just fresh for the next week for the exam. So you should be able to, hopefully, if we get a similar question, we may be able to work on a thing like this. And now, not there, not then. So on the revaluation, we will have a 19.2 figure. So 2.4 million will go into the revaluation figure. So the remaining 8 floors, now whatever we have to record it because there is no depreciation on the remaining 8 floors. So we have to calculate the entire thing. So when we bought the asset, it was 90 million, 80% of 90 million. 72 million.
Yeah.
Now it is 80% of 96 because it's investment property. We don't depreciate. So 80% of 96. 80% of 96 because it is now revalued for 96. So it is 80% of 96.
Yeah.
76.8.
Yeah.
That one where do we reflect? That 4.8. That 4.8 where do we reflect?
Yeah.
On investment property gain, where do we reflect? Investment property gain. According to IAS 40, it should be taken to the P&L under investment income. It should be taken to the P&L under investment income. So my investment income will go up by another 4.8 because of the investment gain. Now can you quickly calculate the total investment income? So the total investment income, you have the 42, you have the 14.25 or 14.3, you have the 5, then you have a minus 14 on the disposal, then you have a minus 6 on the impairment, and another plus 4.8, that will be your total investment income.
5905.
I got 46. 42 plus 14.3 plus 5 minus 14 minus 6 plus 4.8 plus 4.8.
Oh, hang on. $46.05.
Yeah, 46.5. That's correct. Right, 46.25. So that's the figure that you will have for investment. Now, investment. So a lot of adjustments on the investment income. Remember, one thing what we reviewed was that loss on the gain on disposal, what they had calculated that was wrong. But whatever it is not an investment income. Even if the right, it must be removed. It is part of your P&L. Then the second one was that impairment, but which was a very straightforward one, that we had to remove it, that we had to do it. Then the third one was a bit of a nasty one. Part of the property was own occupied, so that's not the investment property. The balance part was investment property 80%. At the beginning it was 95-80%, at the closing it was 96-80%. The gain we had to put it in the investment income. So altogether, it is 46.5. That's what we have got.
Okay.
Now let's look at the administrative costs. So you got 22 plus 9 plus 18. You have two more adjustments already. We have done that one. One is the service cost on the defined benefit plan.
Yeah.
Should be added up to the channel because they say no entries have been made. That should be added up. And also that last investment property, our own occupied area, we had a 1.2 million depreciation. That should be added up. Right? Own occupied area, the depreciation, we had 1.2. That should be added up. So your total administration expenses should be 22, 9, 18, 10 plus 1.2.
$60.2.
60.2, right? Then we have other expenses.
Yeah, that's where I showed the impairment there. Yeah.
Yeah. You made 37. Why 37?
Yeah, there's an impairment of 6 million and the 3 million provision for the repairs.
Yeah. Yeah, that's correct. So other expenses already we have in our P&L 34. Right? In our P&L we have a 34, a minus 34, then a minus 13.5 and a minus 15.
Yeah.
Now that reversal will go and reduce the expenditure. It will not go and increase the expenditure. That 3 million is 3 million is already included. So your minus 34 will not become minus 37. It will become minus 31.
Yeah, it's because I had the 6 million impairment there as well.
Ah, right. Yeah.
So the impairment.
Impairment we charge it to investment now. That is what happened. Because it was investment property, you know, that got impaired. Anything to do with the investments, we must charge it to the investment income.
Yeah, okay.
Right. So it will be minus 34, minus 13.5, minus 15, plus 3. Plus 3. Also we have, you remember our new goodwill was not 28, it was 18. That 18 need to get depreciated, impaired by 10%. So 1.8 million further additional goodwill impairment in book.
Yeah.
In book. So altogether it will be minus 34, minus 13.5, minus 15, minus 1.8 plus 3.
Yeah.
That gives you the total operating, sorry, so what is that figure?
So that's 34. 58.5.
58.5, I got something. Minus 34.
Yeah,
minus 13.5, minus 15, plus 3, minus 1.8.
Oh, yeah, minus 1.8. 56.7.
Minus 34, minus 13.5, minus 15, minus 1.8, plus 3. 61.3 I'm getting.
Okay. Maybe I'll do it again.
Yeah. Minus 34, minus 13.5, minus 15, minus 1.8, plus 3.
61.3.
61.3. Now you are getting into the shape of the total consolidation, but never forget you must keep the individual columns like what we have worked. the figures, because some of the things are getting adjusted to the individual columns, some of the things are getting adjusted to the parent column. Now, so far, only adjustment that we had in the individual column is in the BOO, the goodwill impairment.
Yeah.
Right? So if you really look at the individual columns in your working, you had in the BOO 1, you had 7290 minus, then you had then of course there was another in the BOO, there was extra depreciation, that 2 million. So in BOO column, it will be 90 minus 72 minus 2, the gross profit will be 16. Investment income is 5, what you said was right. Minus 18 is right. Minus 15 is right. Impairment of goodwill, you worked it out at 2.8, but it will be 1.8.
1.8.
Because you worked it out on the original 28, but what we realized was it is getting changed to 18, so it is 1.8. So if you look at the BOO operating profit, it is going to be 90 minus 72 minus 2, it is 16. 16 investment income plus 5 minus 18 minus 15 minus 1.8, you will have an operating profit of minus 13.8 in your figures.
Okay.
Right? It is minus 13.8. As far as Gini is concerned, you don't have any problems. It's same. Your 33.75 will remain as it is.
Okay.
Parent is concerned, there are a lot of adjustments. From your figure 102.2, we removed for 14, we removed a 6, we brought a 4.8, we removed a 10, we removed a 1.2, and we included another 3 plus the reversal. So all that together should be 85.2. I'll send you these workings once I do this thing. Right.
Okay.
So up to that point, operating profit, we are all right. Now we come to the net finance cost. Net finance cost, we have the parent minus 2, that's all right. Gini, it will be 4.5, that is all right. BOO, it will be 9. The total altogether, there is a figure, but we need to add to the parent another 1.4. That is the interest on the pension scheme. The opening deficit was 14 million. 10% on the 14 million, we would have added to the parent another 1.4.
Okay.
Remember, as I said, in the P&L adjustments for pension scheme, always the service cost should get charged to the P&L. Finance charge on the opening balance. If it's a net deficit, it's a charge. If it's a net credit, it is a income. Should get charged to the interest, finance charges. Remeasurement will always go to the OCI.
Yeah.
These are the 3 entries you will always get from the thing. So now you have your net finance cost coming up, and now already you have to include at this point that group loss on disposal, which we worked it out earlier, 8 million. Group profit on loss on disposal, 8 million. That must get included under the parent column. You remember we worked it out that 8 million, that must get included. Then the next one, I think share of associate company profit, you have correctly worked it out 3.2 million. So now I want you to look at very specially Gini column. Gini column will be 33.8 minus 4.5. Your figure 29.25. Gini column, profit before tax. BOO column, it will be slight adjustments because we increased by 1.8 and another 2 million, and therefore your Gini BOO column, it will be 22.8. profit before tax. You had a
Yeah.
16.2, but there were a couple of adjustments to be done. It will be 22.8. CP column, you can work it out later. It should be 77, profit before tax. Income tax, you have worked it out correctly, 35.3, and rightly you have worked it out, the 3 million plus. 3 million plus, that is all right. So now we have, I want you to note down on your last line, profit or loss for the year. I want you to take it, the parent part is 47, Genie is 24, which we have done, and Boo is 19.8 minus.
Yeah.
Altogether, it is 47 plus 24 minus 19.8, 51.2. Total column, 51.2.
Okay.
Now we have, let's look at this other comprehensive income. There are a couple of things there before we go to the, actually what we do is, we work right up to this point, then we work the OCI also. Distribution is done in 2 slides for the profit for the year, parent and NCI separately, and OCI, parent and NCI separately after working out the whole set of figures. So now we have got all the figures. So I'm now coming to the other comprehensive income. I want to look at that one very carefully with you. All right. Comprehensive income, we have the parent 14, which is all right. Then subsidiary, other comprehensive income. We work it out that way. Yeah. Yeah. That 12 should have come. 16 is the other comprehensive income. 9 over 12 should have come. 12 million.
Yeah.
Under subsidiary column. I think it is, I did not see that figure in your workings.
No.
You are not included that, no?
Not under subsidiary, no.
No. So that 12 should come under subsidiary. Under parent,
Yeah.
it should be 14. And under subsidiary, it should be 12. Under subsidiary, it should be 12. Then,
Yeah.
remeasurement of the pension scheme under parent 4. Under parent 4.
Yeah.
Then, of the 4 million of the subsidiary, OCI, subsidiary, the balance 4 million, the last 3 months, we are entitled of that 4 million, how much? Because we are a 40% subsidiary. Sorry, 40% associate. 40% associate.
Yeah.
So we are entitled for 1.6 million there. Under parent, we must include a 1.6 share of associate company, OCI. Total OCI is 12, 16. 12 will fall into the subsidiary category. 4 will fall into the associate category because after 3 months, last 3 months it was associate. So on the 4 million, 40% is 1.6. Right?
Yeah.
Then you remember there was a gain on the revaluation that the property, our own property, the 20% of the 2 stories, which we revalued, it was 95, 90, 18 minus 18 minus 1.2, it was 16.8 at the closing, but we revalued it at 96, 20%, 19.2. So there was a revaluation reserve of 2.4. That also will fall under parent. what I want you to understand now, send this for you, but I want you to understand the parent company profit before tax, sorry, profit after tax is 47 under consolidation, 24
Yeah.
minus 19.8, which will give us a figure of 51.2. Then
Yeah.
we have OCI, parent, we have a OCI of 14.2.4, the revaluation, plus the remeasurement gain, 4 million, plus share of associate profits 1.6. We have altogether 14, 16.4, 20.4, 22. Subsidiary, we have only 47. Subsidiary, we have 12. So our total comprehensive income is going to be 69, 36, and minus 19.8. And altogether, it will be 51 point, it will be 85.2. Now why I did this one was, I want to work out the NCI. I had to work out the NCI on at this point. I had to work out the NCI at this point. So what we have to look at is the 24 million figure, what we have got from the subsidiary, right? And to see on that 24 million, how much is our NCI figure. That's all we need to work it out. So the 24 million, can you tell me what is the amount that we should give it to the subsidiary, NCI? Now we have worked out the 9 months consolidation. So we have only got 9 months figures. So the NCI was only there for 9 months, isn't it?
Yeah.
So what is the figure we should get from this 24 million for the NCI? NCI. 24 million. How much for the NCI? 40%, isn't it?
Yeah, 40%.
Yeah. So on that one, we will have on the second company called Genie, 40% of 24, 9.6. Third company Boo, 19.8, 20% because we hold 18%, but that's a loss. 19.8, 20% comes out to 3.96, so we can make it 4 million. So 9.6 is a profit, 4 million is a loss. So total NCI should be 5.6.
Yeah.
So out of 51.2, 5.6 NCI, the balance should be shown under the parent, attributable to the parent. So 45.6 should be attributable to the parent, and that one. So that's all right. Now we come to the total comprehensive income. The total comprehensive income. So the total comprehensive income, we have what we have to look at is again the second subsidiary. The second subsidiary, the total comprehensive income is 36. Of 36, 40%. So 40% of 36 is 14.4.
Yes.
Profit. But we have no, the other one no changes, so it is the same 4 million loss. So we will have a 10.4. So this will be split 10.4 to NCI, 85.2 minus 10.4, the balance will come to the parent.
Yeah.
The balance will come to the parent. So you can see it's a huge sum. I would encourage you to go to this sum again, because I believe it's in one of the pilot papers. It's not yet has come up in the question paper. So let's hope we will get a question like this, right? Just go to all these workings. Try to do it. I will also try to do a working and send it to you. What I did was I corrected in your paper everything and try to scan it and send it to you today. So all the things what I looked at your paper, and with all your notes, try to do this question again. Don't worry about the timing. Just try to worry about put in the numbers correctly now.
Okay. Yeah, there's quite a lot that was incorrect on this one.
Yeah. Because I think it covers a fair amount. I think about 60 to 75% of the syllabus gets covered up in this kind of a question.
Yeah.
It had the investment property. It had the IAS 19. It had the part of it being a property, own assets, part of it being an investment property. It had the impairment. It had the revaluations. IAS 16. Almost everything came up in this question. So it's a good question for you to go through. I will also try to correct this and send it to you and do that one. We have a little bit more to do on this question, the second part, but we will do that one also, because that was also, I thought it was a fairly interesting one.
Yeah. Okay.
We have seen about the alternative accounting practices, because this is also a very famous question, IAS 19, and also about the defined benefit scheme, something. So we will look at these two also, and tomorrow we will look at something on the financial instruments.
Okay.
Right. So we will meet at the same time tomorrow, and we'll try to work through some of these areas.
Right. Okay then. Thank you, Kuma.
Okay. Have a great day.
You too. Bye.
Bye. Bye, Fiona.